Hi there. In this video, we will delve deeper into our economic analysis. And when we conduct the economic analysis, the most commonly used tool is the demand curve and the supply curve, and definitely their interaction subsequently. So let's begin with the demand curve. As we know that it's a function and it allows us to make a curve or a diagram. So it means that it's a relationship between two variables. Straight away, we can come to this curve. It is basically a curve between quantity demanded and the value it has, that is the price. And you can see it has a negative slope. No matter we talk about this line or that line, it is a negative slope, and it has a justifying reason that whenever the price of a certain commodity or service increases, the demand for it, the quantity demanded for it, should decrease. And whenever the price of a certain variable decreases, it is going to increase the quantity demanded of it. It means that there is a negative relationship. The variables, they are moving in an opposite direction. This is why this line has a negative slope. So this is the basic concept of a demand curve. And when we see that there is another demand curve that has the same slope, it is parallel to the original demand curve, we can see that it's a kind of shift which is happening because the same slope has been shifted to another higher level. So this is known as the shift of the demand curve, and actually it is the increase in the demand, not the quantity demanded, because the quantity demanded happens at on the same curve. Along the curve it happens from this point to that point. But here the increase in demand altogether shifts the whole demand curve to a different level. It can go outwards, it can shrink inwards, depending upon the factor which is influencing it. Now, what are the factors that are capable of causing a change in the demand, either increase or decrease? They are the non-on price factors. When I say non-on price factors, it means that they are not related to price of the same good. It can be price factor, but not its own price, but the price of some other commodity. That is, price of a related good. And when we say price of a related good, it can be either a complement or a substitute. Either a change in the price of a complement can affect the quantity demanded of a certain related good, or it can be some other type of good that is a substitute. So complements and substitutes, they have the tendency of affecting the demand of a certain good. In the following examples, we will see various examples of it. It's just the introduction of what are those non-on price factors. It can be income that can shift the demand favorably if the income is increasing, or it can shrink the demand inwards if it is decreasing. The taste can also determine if the taste for that certain commodity has increased or has become desired, then there will be an increase in the demand, and vice versa. Location, whether they can also favorably or unfavorably affect the demand, that is, increase it or decrease it. Now we talk about these factors, and they can also be termed as demand changers because they have the ability to change the demand curve. The higher value of a given quantity can happen, or a higher quantity at a given price can happen. Because if I consider this quantity, it will lead to this price. But if I extend this to the shifted demand curve, it will lead to higher price or higher value. So you see, the shift can bring this change, that a same quantity demanded can lead to a higher price. And if we draw the line from the price axis, this will be the quantity demanded at this price. And if I consider the shifted demand curve, this will be the quantity demanded. So you see, the quantity demanded has become higher at the given or the same price. So this is the change that we can observe once we introduce the increase in the demand or decrease in the demand. We have listed those factors before: income, price of the related good, and related good can be either a complement or a substitute. The technology can also be a factor that can affect, and the preferences they can also affect. So complements basically can be in for example, in a form of a CPU and a monitor, because when we use these two goods together, they are going to give us a PC that we can use. And if the price of the CPUs, if it increases, it is going to decrease the demand for the monitor, because we know that CPU is expensive. So if we reduce buying CPUs, the demand for monitor will also fall. So you see, the complements have the same opposite relationship between the two, that is price and the quantity demanded of a certain complement couple of goods. Gasoline and automobiles are also complements. They are used together. And hotels and air travel, they are also complements, because once we do the air travel, it is likely and very much likely that we will stay in the hotels. There are also the substitutes. For example, if the price of Honda vehicles, if it increases, it is going to increase the demand of the substitute vehicles, that is the vehicles of Toyota. In addition, we have digital tabs and laptops. They are also substitutes. If we do not have laptop, we can use tabs and vice versa. So their prices and their quantity demanded, they are also related. So you see that these can affect the quantity demanded and quantity supplied as well. As we go ahead in the next part of this lecture, that how quantity supplied can also be affected. But in this case, we are focusing on quantity demanded. Income can also affect the quantity demanded and can give us interesting real life interpretations. It can tell us about the nature of the good that we are considering. Because if the quantity demanded of a certain good falls, if the income is falling, then we can say that it is a good that we are not preferring much, or we consider it as an inferior good. This is why, as we have an increasing income, we would like to substitute this good, and we would like to bring in some other type of good which is superior to it. So it can include canned food, it can include public transport. If we have higher incomes, we will shift to our own vehicles instead of using the public transport. So it can be considered as an inferior good. Then we have a normal good. Normal good, definitely, as the name says, is going to follow the law of demand. And as the quantity demanded is related with the income, the rise in the income will increase it. That is, as the income increases, it is going to increase the quantity demanded of that certain good, which is normal good. So it follows the law of demand, and here it follows a certain pattern that as our income increases, for example, the demand for clothing will increase, and the demand for household appliances will also increase because the income has increased. So it can be termed as the normal good. The higher level of the good spectrum would be the luxury goods. And the luxury goods, they have a certain relationship, because their response to the quantity to the increase in income in terms of their quantity demanded is quite large. So the luxury goods, when the income increases, people are shifted considerably towards these goods, and that's why the quantity demanded will also increase. But if the income decreases, the first thing that we would like to let go will be the luxury goods. We will definitely avoid losing the normal goods, and we will shift back to inferior goods, but we will, in the first step, let go the luxury goods. This is why the response is quite high when it comes to luxury goods. So this is how income can help us to understand the nature of a certain good in the demand analysis. So after understanding the basics of demand curve, we can also understand the supply curve, which is the other side of the market where the supplier exists and supplies various units of the good or service at a certain level of price. So quantity supplied is on x-axis and price is plotted on y-axis, and you can see a positively sloped curve is there. It means that as the price of the certain good increases in the market, the seller is more willing to supply the same good. And if we choose a certain point on that curve, that is supply curve, it can give us a certain point of quantity supplied and certain price, which is the market price. And above it and below this price line and above this supply line, we have there lies that area which shows the excess receipts, and in other words the profit that the supplier can make by selling at this price. So this is the to accept, and above it there is the profit portion. So this is the supply function, and we can further understand it in the possibility of having shifts in it. And the favorable shift is visible because the initial supply curve was here, and this is the shifted supply curve. It is expanded because some favorable change has happened. It can be technology. Technology can shift the supply curve outward, and you can see that it has expanded. Now, other factors that can affect, they can include the price of the related goods. For example, increase in the price of a complement increases the supply of a good. In case of a joint production, we know that natural gas and oil, they can be produced jointly. Lumber and wood chips, they can also be produced jointly. So if the price of natural gas increases, the supply of natural gas will also increase. But natural gas is produced side by side the oil, so the supply of natural gas will also lead to increased supply of oil. So this is how the supply will be affected. Another situation will be when the price of lumber it increases, it is going to increase the supply of lumber. So when that happens, wood chip supply will also increase because they are jointly produced. So this is how the supply side gets affected when it comes to the price of the related goods. When we talk about the substitutes, we have to consider that if the price of corn, if it increases, it is going to decrease the quantity supplied of soya beans, because more expensive corn will lead to greater supply of corn, and the supplier will be less interested in supplying soya beans. Similarly, if the price of a military aircraft, if it increases, the supplier will be interested in supplying more of the military aircraft, and the quantity supplied of the civilian aircraft will accordingly decrease, since they can be considered as remote substitutes, safely speaking. Otherwise, these are also substitutes at different levels depending upon their usage. We have quite a bit of idea about the individual demand and supply curves, but we can also derive the market demand and market supply curves. Here we are considering the example of a market demand curve, and here the process is simply the horizontal summation of the individual demand or the supply curves. As you can see, we have quantity demanded on x-axis and price on the y-axis, and we are having two individuals with their demand curves, that is D1 and D2. We can horizontally sum these, that is D1 and D2. When we do, it becomes another demand curve which is having the influence of D1 and D together, and definitely it is having lesser slope as compared to these two. So simply it is the horizontal summation of the individual's demand curve. Finally, we come to the interaction of the demand and the supply curves. This will give rise to equilibrium. Let us see that how this equilibrium takes place. It is basically a steady state concept, which means that it is a desirable situation and the change in it is not likely. And since the change is not likely, so if the equilibrium price or the going price, if it is there, and will be deprived of the trade because they are following the going price, that is the market price. So the market price is that price which is desirable for the traders, that is the buyers and the sellers. Let us see that how this can happen. Absence of equilibrium can also happen, but before that the supply curve and the demand curves are combined in this quantity and the price space. And you can see that naturally there will be an intersection because they have opposite slopes. This is that point of intersection which gives rise to the equilibrium price, and this gives rise to equilibrium output on x-axis. Naturally, it is the equality of the two values, that is the value of the supply at this point and the value of the demand at this point. So it is called equilibrium because there is balance in it, not just because they are equal, but also because there is a tendency to move towards this point, no matter if we are above this point or below. Because if we consider that the market price is here somewhere, it means that at this level the demand curve is having this point. This means that the demand is this much, whereas the same line would lead to the supply curve at this point. So this is supply curve. The difference between the two shows that demand is smaller as compared to supply if we consider the distance from the left. So the demand curve and the supply curve have this disparity, and there is surplus because supply is greater than the demand. So when there is a surplus of some good or service in the market, it will become cheaper, leading to this fall in the price. And this is that point where it should become stable because the surplus would be removed at this point, and hence no tendency for the price to change. And if we consider the other possibility that if the equilibrium price is at this point, we can connect it with the first curve, which is the supply curve in this case. So supply is this much starting from the left, and the demand is this much starting from the left. So this means that the demand is greater as compared to supply. So if the demand is greater, there will be shortage of that certain good or service, which means that the price will become higher as there is shortage of that certain commodity, and it will reach this point, that is the price will boost up to this level where the shortage is not there anymore and there is stability. So you see that there is inherent tendency of the price to change in order to adjust the shortages or the surpluses and remove them, consequently leading to the equilibrium. So this is why it is an equilibrium, because there is a tendency to be at this point, and therefore the going price or the market price is that point where the buyers and the sellers, they are at ease and they can easily do the trade. This is a very famous tool, the market equilibrium, and this is why we can say it's a kind of universal tool, and this can be extended to a set of different markets. For example, if we consider goods market, it is a type of market where the goods are being bought and sold. For example, iPads, they are bought and sold, and that place is known as the goods market. Services market is also there, where the psychiatrists, they give their services to the patients, and the psychiatrists, they are hired by those patients. Labor market is an example of the service market where there is demand for labor and there is supply of labor. So instead of simple demand of goods and services and supply, we can have demand for labor and demand and supply of labor as well. That is the concept of a labor market. When we talk about capital market, it is the market where there is a borrower and there is a lender. One who is lending the funds is basically providing the supply of loanable funds, which is actually the saver who puts his amount in the financial firm or a bank, from where a borrower can get those loanable funds by demanding for them. And there is a market since there is demand and there is supply of those loanable funds. We also have money market. Demand for money and the supply of money is also there, because people demand for money for transaction purposes, for precautionary measures, and there is supply of money by the Central Monetary Authority that has the discretion of publishing new currency and controlling the interest rates and supply of money as well. So that is also an example of market, and it is known as the money market. So this is how the universal tools of demand supply can interact to give us a certain point that will guide us about the market price and market output, which is an important situation to know in a certain market. The types of the markets are also explained. The market demand curve is also plotted here. You can make the market supply curve as well by horizontally summing the supply curves. And we also have understood the effect of related prices goods on the supply curve, how these shifts in the supply curve happen. And we have also understood the supply function itself. Before that, there was demand function. We also understood those factors that can cause a shift in the demand function. This is the diagrammatical depiction, and this is how the demand and the supply functions have been explained in this video. In the next video, we will learn that how we can make these demand functions and supply functions, how we can come up with these functions. Thank you.